first, but just in case. Okay, let's go on to the next. Investors can be confidently can confidently predict future returns on an investment by studying its past performance. False or true? There is no depends answer.
Not confidently.
Yeah. So it must be false.
Yeah.
So if you think not confidently, it must be false. Yes, past returns do not necessarily predict the future returns, can they? In the past, I mean, if I want to invest for the next 20 years, should I study past 20 years stocks returns? In the past, I've seen two sort of upturns and downturns, right? The improvement over the property markets and then boom, bust, and improvement over stock market appreciation over the dot-com bubble and then bust. And then next 10 years, we'll have a Brexit completely done. So the future returns are not predictable, right?
Do you think the influence of Brexit will be that low?
Yeah, the reason is a lot of U.S. banks, United States banks, the investment banks, want to move over to continental Europe, which means the financial markets will be thinning, like little activity, not as much activity as before.
But they can just move it to Ireland.
Yeah, they want to move mainland Europe. I don't know why they won't move to Ireland, but they want.
Ireland is still part of Europe.
Yeah, it is, but
Even after Brexit.
I think mainland Europe having it's of course the same thing, but they want to move to Frankfurt or Paris one. I don't remember DAX. So either one will get it basically. Either financial markets will not London Stock Exchange in the future if government doesn't allow them what they want. I guess they won't lose much from Brexit, but it's a chance for them to negotiate to reduce the tax. So they know it that it's not much. Most of the London Stock Exchange transactions, obviously, between European partners and European companies and local probably trade takes place. Britain's exports are to Europe mostly, and then to US and then Japan, not to Asia even. Yeah, but it's for them a chance. Probably it's a political thing for now. But yeah, it certainly has an effect if US financial companies move away from it, and they will be trading mostly in euro denominated shares and bonds. So there's a lot of different factors, but it's usually not predictable. But anyway, so it's false. Yeah, number 4 is false. They cannot be confidently predicting for the given reasons, and you can think of another. Okay, the return that fully compensates for the risk of an investment is called the risk-free rate of return. True, false? Read it, please. I'll wait. You need to understand the question. Number 5.
Isn't the risk-free rate for investments that don't have risk?
So
it's false.
It's false, yeah? Risk-free rate is interest rate usually offered by risk-free instruments. So there is no risk. It's false. The required return on a risky investment includes a real rate of return, an inflation premium, and a risk premium. What's the required rate of return?
The return you want on what you're buying.
Yeah, it's the return that investors require when they invest in a vehicle or security. It's just the name required rate of return suggests you. So you would like to have real rate of return, which is after accounted for inflation, plus compensation for inflation, because inflation, prices go up. So, and you also want to have some risk premium. Why? Because you may be investing in a risky asset, so you require premium, for this investment. Usually, risk premium increases as the riskiness of the assets increase. Yeah. Shares, for example, of all the normal standard securities, not the derivatives. So of all these standard securities, usually backed by fundamental cash flows, these are stock is basically most riskiest. So you have bonds. The bonds are risky as well, corporate bonds especially, but they are not as risky as stocks. The reason is
You think bonds are risky?
Corporate bonds, quite risky. But why aren't they as risky as the shares? There is a question, for example, why are stocks are more riskier than corporate bonds? You know, I have a company. Let's say Tesco issues corporate bond at 5% per annum, issues shares at the same time. Then if I'm an investor, I would be thinking stocks of Tesco are more riskier than bonds. Why? As a rational investor, that's what I think.
There's a bigger chance of it going down quicker than bonds, and bonds you're going to get at least like enough kind of return. With stocks, you don't really know.
Yeah, at least something, yeah, fixed. So if you carry on explaining it
It's
further,
a loan, bonds, like giving debt. It's a debt of the company.
yeah, it's obligation, isn't it? To
Yeah,
pay back.
you should pay
Shares.
back.
You
don't
just
care.
invest £1,000, Tesco
You know what you're buying.
may become bankrupt and you lose everything. But with the bonds, you buy £1,000 worth of bonds of Tesco, Tesco goes bankrupt, then liquidator comes in, sells the assets and pays you. That's why shares are riskier than bonds. Yeah, keep that in mind as well. Debt securities are less risky. Obviously, they also come in different forms and different risk levels. Yeah, they have different, but you require compensation. So for that reason, returns from shares are higher usually on average than the returns from investing in bonds. Keep that in mind as well. Historical, we'll come to that in slides. There's a table where it shows bond returns and share returns and others. You will see that, and they are also risky. Number 7. If the risk-free rate of return is less than the inflation rate, the real rate of return is negative. Anyone?
False.
False?
Yeah.
Why?
Isn't it if the nominal rate of return is less?
We don't have the nominal rate of return in this case, but it's the next one
But
probably.
instead of the risk-free,
So you have basically here. Okay, so what's risk-free rate of return is equal to? Real rate of return plus inflation. This is risk-free rate of return. Yeah, this is what you get from investing in US bonds. Oh, sorry, US Treasury bills. Risk-free rate of return. It will have a component of real rate of return and inflation rate. Now, if inflation rate, for example, is 7%, huge
It doesn't
inflation,
affect us.
and 2% here, risk-free rate, yeah. So if this is greater, then real rate of return, for example, will be negative, isn't it? If it goes up.
So that's true.
Let's say this was 5% risk-free last year, and this is 7% this year. Taking this back here, you will get 5 minus 7 equal 2% negative. Inflation rate might eat into your returns, real rates of return. Yeah, inflation rate could be higher. Anything else you want to ask? Next question, number 8.
Sir, so what is like the result of hyperinflation?
Yeah, that's gonna lead to negative. Yeah.
Extreme-
Yeah, that's the Zimbabwe. It's very, if you bought the Zimbabwe government bonds, that's what you're gonna get. Number 8. It's another way of asking the same question basically. Yeah. If you remember the formula for risk-free rate, real rate plus inflation, right? And we just said inflation rate could be much higher than risk-free rate, and usually this is nominal. Yeah, hyperinflation situation means risk-free rate could be, 5% still, but with the sudden boom in the inflation rate, it just reduces the purchasing power of your investment. Yeah. Okay. Next question: margin trading. Oh. It's for you. Sorry. Margin trading requires the borrowing of securities. Does it or doesn't?
False.
False. Okay. Anyone else want to add to that? And anyone who says true, can you explain, or false?
Doesn't it involve
Yeah.
leverage?
It is leverage, isn't it? Not borrowing. Borrowing of securities involve what? When do you borrow securities? For what purposes?
To purchase stock.
Sorry?
To purchase stock.
You borrow securities to purchase stock?
Not security.
I think you want it with me now. To purchase stock, yes, you have a margin account, but I was continuing on his state. When do you borrow securities, and for what reason?
Short.
Short selling, isn't it? You borrow securities, short sell, and margin trading is you borrow cash from the broker, right? So 50% margin trading account implies 50% of the investment has to be your own equity, the amount of money that you put, and another 50% can be borrowed from the broker. And in the end, once you close your position, you pay back that part that you borrowed from the broker, plus the interest payment you make, and then all the returns that you have received will be your own holding period return, whatever holding period is for you. Okay, number 10. Read it first. Maybe if you read the question, you will understand it better. True? Yeah. Tell us why.
Basically, wasn't it that you would borrow securities and then you would exactly like it says there.
Yeah, go on. I'm listening to you.
Basically, you borrow securities and you would sell them at a less price, or you would bet upon that the price is falling.
Okay.
Um,
So when?
You sell it and then you expect it to go down and then you rebuy it once it's
Yeah.
at a lower price.
Yeah. That's
So
if
it's
you.
true.
Yeah. It's true. Yeah. If you continue that, what you just started, basically, just let me just do it again here. Easier to explain with the graphs and stuff. Let's say if you want to short sell, let's say this is stock price moving up on a trend. At this point in time, let's say T today, you expect the shares to go down. You expect shares to go down somewhere here. Because it is bad news about the company, basically, that you are expected to be released. It's actually insider trading in that, isn't it? You have to guess to be not insider trader. If you expect that, you just call your broker. At this point, today, you call your broker and say, tomorrow, I will need 1,000 shares of this stock. Broker then will probably ask you why, but you can explain, give them any other things, any other answers. So they provide you this shares from another account, because the brokers manage different accounts. So they take this from another account and lend it to you. This bunch of stocks, then you will sell the next morning. And once you shorted these stocks, you are short selling now, yeah? You shorted these stocks, means you pray that the share price goes down, because let's say you sold them at £50 a share or $1 a share. You pray that share price will be less than £50 because you need to put the stocks back to the place at a lower price to make the gain. So assuming that it went down, you may buy them at $30 a share.
And you make those.
Then the return is basically $20 a share that you make when you purchase them back and give them back to the broker.
So the people who shorted the financial crisis.
Yeah, there are cases of big short sales expecting, well, obviously when financial crisis kicks in, expect everything to go down. And short selling makes it even worse. Brokers will start telling other investors to short sell the stocks if they find out that someone short sells for a reason. And this is the brokers who usually create all this because they advise you what to do. Yeah, they might tell you, okay, I had a big investor, usually trades in millions. I see you have £1 million, this much of stock here. You need to sell the stock as soon as possible because they are short selling. They might know that stock is going to go in price, or there's some bad news coming forward. Or in the financial crisis, obviously, it's natural to advise to sell as soon as possible before the price goes down. And that's what it is basically. And then I think U.S. government banned short sales for a while there, not the short sales, certain stock, not all, different stocks. And
But at what point is it illegal, like, certain insider trading? Because, you can work at a company and think that obviously if something big's going to happen, you can speculate and think that, all right, I'm going to sell this. But would that's not necessarily all the time legal?
if you are in a position of power there, it really is illegal to share. Also, if you are in a position of managing this information, then it's also illegal. But if you're not managing, it's not, because you don't have relation to this. I'll tell you just a quick example. A second-year student working, having an internship for a brokerage company in England. I think it was in London. I read it on a couple of years ago in the news. Basically, he's a student. He was given a desk to trade. Well, to do whatever. I think it's a trading desk. They said it's a desk, so I presume it's a desk. He would chat with his father through messaging service. And the newspaper didn't release what the messaging service was. Messenger service, sorry. So he would chat on a daily basis with the other party. It turns out to be his father, to buy and sell on the same day. Buy in the morning, sell that stock by the time the day closes. So he would do that over a long time. And at some point, there was a big news coming in, and brokers knew it. The company knew it, and the big company also knew it. I think it was a pharmaceutical company, most likely, because of approval was rejected, or the proposal for licensing the new drug was rejected for the pharmaceutical company, and brokerage company that he was working with the pharmaceutical company. And what happened is that previously, when this pharmaceutical company applied for the approval of this drug sales to commercialize the drug that they developed, there was a good news. Share price went up in the expectation that the additional revenue from sales of new drugs will generate more dividends. So the prices go up quickly because people start buying this stuff. And now the approval process takes about 8 months or more than that. So the process came to the close, and it was negative result. And before the announcement went to the market, the brokerage company knew it. But this guy, then what happened is that he just texted his father, sell these shares of this company, because he was also expecting the approval to be positive news, and it will go further up.
So did you get arrested?
They sold, and on that day, a lot of people sold, and the Financial Services Authority in London started checking why they sold few days before the announcement. And if the person had a direct link, that person who has some other links there would usually be questioned. And if there's reasonable assumption or reasonable reasons for charging this person, they usually announce that it's insider trading. It turns out when they questioned this guy, he basically confessed to this thing, and they then read the messages, obviously emails that they exchanged. So that's insider trading, really bad, because it goes down, in that. So I think it was a case of short sell, short the stock while it's high in price, sell it when it's low in price, and that happened, and a lot of So it's a lot of activity basically around it before the announcement tells you that's an insider trading. And I read yesterday about a CEO of a company trading his own stock before the announcement of bad news. That's another insider. He was banned from. Hmm? Yeah, they caught him. Yeah, it was very obvious thing, but it was silly. Okay. Anyway, so next thing is multiple choice questions. Stocks and bonds are traded in. Where are they traded? Is it? Guys, is it D? So Securities and Exchange Commission is an regulatory organization, out of the question. Yeah, it's out of choice. In other words, you just cross over if you don't know the answer. Money markets, you know that it's for debt securities only, not for stocks, and for other securities, but not debt, or even not so stocks only. So you just cross over. Federal Trade Commission is not, again, another commission, so it's not a market. So it must be the obvious reason, capital markets. If you don't know the answer, just cross over those who are least likely choices, basically. Okay. In some markets, it may take many months to sell a residential property. This is an example of liquidity risk. Yeah, that is liquidity risk because the market is not liquid for properties, implies that it's hard to sell. The same behavior in stock markets. If you buy shares, you have to buy shares that are easy to sell. When shares are easy to sell, they are liquid shares. If you buy homes, you have to buy homes which are easy to sell in the end. You don't buy a home at cul-de-sac, or at remote location. Yeah, the market for it is very illiquid. People may not buy it. Not every day you get. If you buy property in center of London, obviously that's highly liquid market at a low price, obviously. Okay, 3. What do you think kind of risk it is? This is something that I'm going to talk today, but it was already in the slides that I uploaded. So if you read the slides, you might have seen the answer to this. Easy to find the answer easily. But if not, then that's fine. We covered it today. Anyone?
Depends how we drown,
I'll tell you another thing. Similar. Yesterday, Trump and Hillary debated. What happened to financial markets? They started being volatile to the upside volatility. The stocks started gaining a bit. Bond markets started gaining a bit because the perception is that Hillary Clinton won it by a huge margin. So events risk. That event basically boosted the positive event, boosted the markets. The same here. This event, if obviously it's an event risk, if the guy is a good guy, like Apple's Steve Jobs, when Apple announced that Steve Jobs is taking a short holiday break for health reasons, the stock price went down by about 5%, I think it was, because people didn't know how bad it was, the health. But they knew that his departure is a bad thing for the company. He was the visionary person, design, and all these things that we have now, these things are designed by him basically, or under his leadership. So these shiny products will bring more revenue and more dividends, so investors would like to have him there. But because of uncertainty, share price went down a bit. So eventually they announced that he's not going to go back, and the share price by then it was already known, so share price smoothly it smoothed the volatility. Yeah, it just smoothed it down. If it was like a big news, big announcement that he's not gonna come back, it will be a big drop. So they kind of managed the event risk. Next, inflation trends to have a particular negative impact on the price of.
What was the answer to the last one?
Huh?
What was the answer to the last one?
Events risk. Event risk. You remember the events that I just described?
Yeah.
They have a different risk. Impact on share prices. And this time, the CEO dying basically. Yeah. Interesting risk types. Yeah. Some certain events usually unpredictable, and they are risky as well. Yeah. An example could be the accident that Google had yesterday. Google car. You know that what happened to Google car?
It crashed.
No,
It's all
it crashed basically. Not its own. The intelligent car. They call it what you call. They call it
AI technology.
automatic
Driverless-
driverless car. They were testing, and some guy just basically crashed his car onto the side of this car, and Google the car cannot be moved at all because it automatically shuts down, so it cannot be moved. And markets start reacting negatively to this news, to the Google prices. If you look at the Google price, there's a slight decline there.
But if that guy wasn't driving, maybe that automatic car wouldn't have crashed.
Who knows? But it looks like the car stopped, punched the brake first than the guy driving it, because actually it stopped right in the middle, and then the other guy was the other driver actually crashed into the car driver. So anyway, so this event basically is a risky event, and it has a negative effect on the Google prices. So people think that the investors will think that now, given the defect in the car, or maybe given the weak side of the car, there will be less demand, and Google already plowed a lot of money in there, and it's lost sunk cost, isn't it? When there is a huge sunk cost, expectation of huge sunk cost, you won't buy shares of Google. Yeah, you would rather sell them now. Okay, that's what event risk is. What do you think? Which of the stocks will have, which of these investments or securities will have a negative impact from inflation trends? If inflation goes up or goes down, what's highly affected?
Real estate? Bonds.
Bonds?
Uh,
It's bonds, isn't it? Yeah, you have interest payments. Let's say you are issuing interest bearing bonds or interest paying bonds. Yeah, there are ones who are discounted as well, and your bond is trading at £1,000 now. You're paying coupon at a rate of 5%, but similar bonds are now trading at 7%. So people, instead of buying your bonds, will invest in the other bonds because the interest rate has gone up to 7%, right? They have the same risk, but they offer higher rate return. Yeah. So to sell your bonds, the investors have to reduce their price. Yeah. So it affects the price.
so
Yeah.
how would it affect, the mortgage?
Yeah, it will also affect as well. It might have, but inflation rate is tiny in terms. When you look at the thing on top of the mortgages, then mortgage rates are usually flat. So yeah, go on. But certainly all of them are affected. But then you have a negative effect in the inflation.
So why is inflation rate now? Why is it low?
Why is it
still
low?
Yeah, it's still low for a long time.
I don't know that actually. To be honest, I
Isn't
don't
this
know.
a problem?
No, it's not problem. It's problem when it's deflation.
It's like 0.0 or something, right? 0. Something.
I don't know the interest rate, inflation rate now. To be honest, what's the inflation rate, guys? I don't know.
0.2.
Hmm? Usually annual interest rates are around 2%, average annual interest rate. But quarterly, monthly, I don't know what it is.
No.
We expect the prices to go down.
Yearly. It's like
Annual, 0.2%.
Yeah,
Yeah.
it's been like that for the past 2 years.
Yeah,
For some reason, I don't know. To be honest. It will be problem for, of course, having that low interest rate, inflation rates are problem because if that's 0.2%.
Low since the prices.
No, I know after 2009, inflation rates, actually there was deflation, not even inflation. And then it didn't pick up for a while, but I didn't realize that it has been low, that low. The reason it's bad is if the prices do not rise, companies do not make enough margins. Yeah, they cannot make enough margins because competitors holding the price down, like Asda holding the price down for some group product. Tesco cannot increase it. So it has to price around that price, yeah. So these low margins will eat into all these profits that could already be paid or could be paid as dividends to the yeah.
There's a theory. Some people I've heard people saying that oil prices when they fall, inflation falls.
Yeah, that's oil price. For example, the reason the oil price affects the
Why?
inflation rate affects the oil price is because gasoline is in the basket of CPI calculation, gasoline. When you calculate inflation rate, you calculate the consumer price index. And consumer price index is calculated using the basket of goods average price. So every month, Bank of England receives the price for bread, milk, shoes you buy, holidays that you take every month, airline tickets, prices. Every month they take them, certain day. House prices started being being
because of transportation costs too. Like transportation, like gasoline you need it for transportation. So if you wanna like make bread, okay, there is some sort of transportation.
No, there's always, yeah,
You
okay.
need to get the I don't know, the flour,
Mhm.
take it to the place,
Mhm.
the bakery and all this. But I mean like what is the correlation between crude oil and inflation?
No, you mean the prices?
Because I don't know,
Positive, of course.
in the beginning of 2016, crude oil prices they were going down, right?
Mhm.
And inflation was also going down with it. But why? Is it
No,
just
I mean, if I remember, I did this about 3 years ago. Crude oil price may not affect the inflation rate at all if the producer of gasoline, because crude oil is a crude oil, not gasoline yet, gasoline passes this decline in price over to the customers. When the gas prices go down, that's when inflation goes down. Oil price going down and correlation is there is little. Now another thing is the
When crude oil
transportation
goes
wise,
down,
you're saying that
gasoline doesn't go
Hmm?
down? When crude oil prices go down, gasoline goes down, right?
not necessarily, because BP might want to charge still higher rate because they want to earn. But however, this is not only gasoline
It
itself.
depends on the country. Like Europe
Yeah,
is
of course.
different than
Yeah, yeah.
America is different than
In Britain, for example, in Britain, when crude oil price go down, what happens is the what you call it, jet fuel for the planes usually go down, which gives a chance for the air tickets to go down for a while, not always. So ticket prices, air ticket prices go down, right? And that is included in CPI. So inflation rate goes down. That's one. The travel companies, the rail companies, they all use electricity and generated through some other sort of fuel. Electricity is not there. Basically, if you don't have the huge dams, you have to generate them using either oil or coal or some other nuclear maybe. So,
Wind. Wind.
wind, well, it's 1-2% in overall usually.
But like in some countries, it's that.
If it has to have small population, then yeah. For now, we don't have enough renewable energy. Anyway, so crude oil price do have a different channels of effect. Not necessarily correlation doesn't necessarily mean causation. So it's not causing what inflation rate to go down usually. It is huge complexity in it. I mean, I did a research and publication on it, but what we see on a face value is completely different when you do the disentangle the effect of crude oil decline. It's a different story. And yeah, you're coming through transportation channel. All the goods will have to be transported at some point, and transportation goods prices go down. Then prices of goods coming from China will go down. But yeah, but we're looking at the British system or American in that case. That's a different story. Anyway, overall prices going down basically is a result of various factors. Okay, go on to the next one, please. Which of the following investments may be impacted by government actions? The quicker the better, guys. Quick. I want you guys to understand, because in the test this will be there. Something like this will be there. You want to be quick in the test. 50 minutes for a midterm.
All of the above.
Who doesn't agree? Okay, all of that above here. All of it, basically. Anything, not all the actions obviously. Changing the interest rates, for example, Bank of England. Change the interest rates affects all of this. GDP, for example. Calculation of GDP is maybe different from one year to the next. Then that, slides a big. And Italy is considering to include drug trade, illegal drug trade, in the GDP. That boosts the GDP. Because the drug clans are quite, anyway. And prostitution, there's huge market for prostitution. They want to include the services as well. By legalizing it, they would start charging prostitutes tax, so that tax revenues plus that basically is a service, isn't it? Okay, number 6, market makers in dealer markets. Did you read the question? If you haven't, then you just said all of them. Please read it. For test, it's important. Who was all of the above, did you say? I was thinking same, sorry. Because I didn't. It's not. They buy securities at a bid price and hope to resell them at a high price. Remember dealer markets, they are NASDAQ. The broker markets would be this one. If the question asks in midterm, in broker markets, brokers do, then you choose A. In dealer markets, then it's C. Please read the question. Exchange traded funds are, I think we did cover this quickly, but I will tell you what it is basically. They are basket of securities that traded like single stock. So for example, I'm an investment banker. I could put together 10 different stocks, package them into one single stock, like exchange traded security, they call it, and trade that in the market, basically. And it trades like a stock. It's a separate stock which has an underlying shares or different types of securities, bonds and all that stuff. Yeah.
It's like diversified.
Yeah, it's a diversified portfolio being traded in stock market. Unlike the mutual funds do the same thing. You invest in funds of different portfolios, right? But mutual funds are not traded in stock markets. Exchange traded securities are traded. So I can, instead of buying 10 stocks, I can buy exchange traded exchange traded security, which basically tells me I'm investing in a portfolio of 10 stocks rather than spreading my pound over 10 stocks. Yeah. Okay. Options contracts on stocks may. Number 8.
Is it C?
Is it C, guys? Okay, let them read.
Yeah, I think C as well.
Let's see, yeah. Depending on the type of contract, grant the owner, options basically, the owner, right to either buy or sell the stock. So it could be two types of contracts. Which ones are they? Option contracts?
Or
Put and call. What's put option?
When think
If you
it's
buy a
gonna
put option?
go up, you think it's gonna go up?
No, what is put option? Option to do what? So if you're buying a put option in some derivatives trading market to sell underlying shares, yeah, for example, or bonds. It's a put option is usually gives you option to sell underlying shares at a fixed time over a period of time. Sorry, not on a point in time. You can sell it between some sort of
like a range.
2 time periods. Yeah, it matures, but within that period you can sell any time as long as you are in the money. Remember the terms:
Yeah.
out of the money, in the money, and at the money. At the money when the prices are equal to your exercise price. Okay, go on to the next one. Which of the following are associated with the bear markets?
Yeah.
Yeah.
Three.
I think you were there when you talked about bear markets.
1 or 3.
103. Others, you have other choices you can think of.
1 and
103.
All of them.
All of them. Actually, we don't have all of them here. Yeah, I have 2, 3, 4, 1, 2, 3, but not all of them. So you have to choose something else.
So everything.
Except maybe economic slowdown.
Do you remember the bear markets? What are they?
Like when the market goes down.
Yeah, it's when there's investor pessimism and economic slowdown. Yeah. So 1 and 3 then, isn't it?
No, it's also rising profits.
Oh no, that's
can
bull
make a lot
market.
of money.
That's a bull market. When the profits rise,
No,
dividends
you can
rise.
make a lot of money if you sell short. You can make more money. Like you can make faster money.
No. What I'm saying is, what is the bear market? What is the characteristics of a bear market?
So when the market is falling.
When the market goes down,
Okay.
generally we say We are in bear phase. So you have a market, share prices.
Well, profits can still go up.
Yeah, but that doesn't necessarily. Bear markets usually, profits usually underlie the stock prices. If the profits are not going up, then prices usually don't go up. If profits go up, then dividends usually go up, which implies stock prices go up. So stock price usually go up in bull. This is bear. So this is all the stock price volatility. Main factor is the profits. In many cases, of course, there's events as well. That dollar-denominated debt securities. Next one, quick guys. Securities issued by foreign corporations and traded in the U.S. markets are called
Yankee bonds.
Yankee bonds. Arya. Okay, you read it. It's a quick one, long one. Quickly. I feel hungry now. Sorry?
Yeah, B.
B? Is everyone happy with that? B? Please read it, everyone, not only a couple of three people here. B. So if you think share prices go down in some sort of stock, in company shares, then you have to short this. Yeah, short them. Okay, short questions. This is actually calculation type questions. Can you read it, please? And calculate it in the next 15 seconds, maybe? Anyone?
6.
6? Possibly? Okay. So we have common stock. Required rate of return is 10%. The current real rate of return is 1%. Very low. Really quite low usually. It's most of the rate of return goes up by driven by the inflation rates. So inflation rate is 3%, and there is another component for this. And if you remember from last week, required rate of return is usually real rate of return, and this is a different required rate of return. RR, this is for required rate of return, this is real rate of return, plus inflation, so you want a compensation for inflation, plus risk premium. Now, here risk premium is then equal to this big RR minus big and small RR minus inflation. And all of this basically is equal to 10, minus, this is, 3 minus 1, this gives us 6%. That's your risk premium for buying the stock. You want compensation because the risk is higher, so you want extra premium. And remember, this makes up, these two will, make up risk-free rate. So that if exam, this question come in different shapes, so it comes in different forms. If it comes about risk-free rate, then you just figure out by jotting down the formula. Okay, next one. The risk-free rate is equal to the real rate of return plus, I just told what it was. Inflation, yeah? Okay, done. Number 3. Kelly bought a stock at a price of this much. She received a dividend and sold the stock for that much. What is Kelly's capital gain on this investment? This is again in the slides.
Dividend plus the difference in stock price.
What's that? Now she's saying no. So she already confirmed. What's that?
It's just what it was sold for minus the price.
Yeah. Capital gain, not the dividend yield. So it's the difference between 29.25 and 27. So it gives you the value, if you calculate that, 20 something, I don't remember. 22.25. Sorry, 2.25. That's the capital gain. It's the gain from price appreciation, not including dividend. Oh, sorry, it's this one. Did I? Yeah, 24.75 minus 22.50. Next one. Ashley purchased the stock at a price of $27 a share, and she received this dividend. After 1 year, Ashley sold the stock at a price of $29.25 a share. What is her percentage holding period return on this investment? Percentage holding period return. So we have to find rate of return in percentage. Piece of paper, jot down, things come direct. I mean, if you have Excel, that's even better. How much did you get? Anyone?
Is it 19.4%?
19.4? Is it? Yes, it is. Two people saying getting the same answer must be correct then. How many of you guys got the same answer? 19.4? Okay, let's do it together then. Right, holding period return is basically the price that you sold this actually sold the shares for. So this is 29.25 minus the price actually bought them for 27. Now she received quarterly dividends, so in a year, because she's holding for a year, 4 quarters times per share dividend per quarter. This is plus, sorry, because it's a dividend income. What else is given? Nothing, right? So divide all of it by the original price. So it's 27, the price that Ashley paid, and it should be 19.4, yeah? These are percentages, so you just, to save space, I didn't put them on. Next. Lauren purchased the stock for a share and sold it 6 months later for that much. While she owned the stock, Lauren received 2 quarterly dividends of that much. What's her holding period return? This must be quicker, guys. Anyone? Holding period return, guys. Just did it, yeah? We just did it. How much? You mean 13%? Yeah. 13.2%. Did you everyone get it, or should I show it? Should I? Okay. The same principle, yeah? HPR. You just need to figure out what to put where. The formula says it's the price 2 minus the original price plus the dividend income over price 1. Now, what do we have? Price 2. What's the price that Ashley sold Lauren here? 31 sold. Minus original price, the price that they bought it for, plus dividend income. How much is it? Because they received it twice during the 6 month holding period. Should be this. Okay, next. So pay attention to these minor things like how often the dividend is paid. Because if it says quarterly, but you just take dividend payment, quarterly dividend payment as a yearly dividend payment, you end up, not including the 3 dividends in the calculation, 3 different dividend payments, because quarterly is 4 times a year. So, and if it's 2 times a 6 month here, basically, in the 6 month period. Next, this guy bought 100 shares of stock for this much per share on 70% margin account. Yeah, use their account basically. So what does it mean, 70% margin?
So is it that you took a loan for 70 or did you put up 70 himself?
I'm asking you that one. I'm asking this question, yeah. What do you think? What 70% margin means?
I think he's paying 70.
Yeah, it is paying 70%. Yeah. He contributed 70% of the investment, total investment. Okay, assume Gary. Is it
Jerry.
Jerry? Is it Jerry?
That's Jerry. Jerry with an
Is with A
Yeah,
is with Gary, isn't it?
exactly.
Okay, so this time is Jerry, G. Okay, Jerry, because I know Tom and Jerry, but it was a different J, wasn't it? Okay, holds the stock for 1 year and his interest costs will be 45 over the holding period. Okay, Jerry also received dividends amounting $30 a share, ignoring commissions. What is his percentage return on invested capital if he is selling the stock for $34? So what do you think, guys? Do you want time for this or do you want me to show it quickly? Show it. Okay, now so we have 100 shares. The return on this will be the price Jerry sold them, 34 times 100, the number of shares. So this is how much he received per share times the 100 shares, minus you have 30, that's what he purchased it for, these 100 shares. So I'll just put $sign just to say that these are monetary units. Now, because he is paying interest, it's going to cost him $45 for the duration of trading, and he received dividend, each share 30p. So 30p times 100 shares. All of it, how much did he invest himself? 70% of how much? 3,000. Because that's his own investment. His return will be calculated on his own money, not on the guy's money who provided. So if you calculate this, you should get magnified return of something like 183.3%. By the way,
What has that return?
times everything by 100% to get the 100.
So like what kind of investment would this be?
Stocks,
Based on
maybe.
Stocks.
Yeah. Stocks, they are risky, so usually they give you high return. And this is actually magnified because if he divided everything by 3,000, that would be a different story. But he's dividing by 2,100. Because that was his own money. So that's the benefit of margin trading. It magnifies, but it also magnifies the losses when the price goes down. Not 34, but 29, for example. Magnifies the return that would be too high. Okay, guys, that's done. But we took about just over an hour of doing this. Next thing is I will upload more problem sets. But you have to do it on your own, guys, in groups, maybe not with the group that you have formed so far, with anyone you have as a, you have built some sort of friendship, maybe not the relationship. I mean, anyone who can help you. Don't work on your own. I see on your own you have different ideas. You might just say true if it's a false statement. Yeah, you might give a different answer and you think that's the right way of calculation. Work together rather than waiting for my answers. Work together, and answers will be very short, not little explanations. So work together, and then you will see compare result. We have 10 minutes, guys. You're going. I wish that we finished a bit earlier, but this is an important thing to look at. I mean, the thing that we've done for midterm, especially for final, we'll do something else. Let me quickly start this. I'll just stop this. Stop screen.